You've seen the headlines. Silver to $3,147. Four-digit silver, generational wealth, monetary reset. Some channels are already pricing out beach houses. Others are calling it delusion. Today, we're going to slow this down. Is there actual math behind a $3,947 silver target? Yes. Is it as simple as copy-paste a ratio and wait? No. On Financial Briefing, we don't do hype. We don't do doom thumbnails. We look at the data, assign probabilities, and build a framework. So let's decode Tavi Costa's math step by step and figure out whether this is crazy or just deeply misunderstood. Before we dive in, quick accountability check. Back in early 2024, when silver was trading around $22, I said a move to $30 within 12 months had about a 60% probability if real yields rolled over. That happened. We tagged the low 30s. In late 2023, I warned that gold breaking $2,100 without confirmation from real rates had only a 40% probability of holding. It pulled back exactly as the 10-year yield pushed higher. And in mid-2022, I was early calling for a dollar top. I gave it a 55% probability. The DXY squeezed higher first, and that caused patience before the eventual reversal. So we get things right, we get things early, and we own both. Now let's unpack the $3,147 silver thesis. The first data point is the gold to silver ratio. Right now, silver is trading roughly in the $32 to $34 range. Gold is hovering around $2,100 to $2,200. That puts the gold to silver ratio near 65 to 70. Historically, the long-term average over the last century is closer to 50 to 60. During extreme monetary stress, like 1980, the ratio compressed toward 15. In 2011, it moved down to about 30. Tavi's math, as I understand it, assumes a future gold price north of $8,000 to $10,000 under a significant monetary reset scenario. Then it assumes a compression of the gold to silver ratio to around 20 or even lower. If gold went to $8,000 and the ratio compressed to 20, silver would trade at $400. If gold went to $10,000 and the ratio compressed to 10, silver hits $1,000. To get near $3,947, you need something like gold north of $10,000 and a ratio closer to 2 or 3, levels we have never seen in modern financial history. What does that mean? It means the silver to $3,147 math is not purely about silver. It's primarily a call on gold exploding and the ratio collapsing to historic extremes, beyond even 1980. What it doesn't mean is that silver itself has intrinsic fundamentals today pointing to 3,000 plus prices. That target is derivative. It's conditional on a systemic monetary repricing. Second data point. Global monetary base expansion. Since 2008, global central bank balance sheets have expanded from roughly $5 trillion combined to well over $30 trillion at the peak in 2021. Even after quantitative tightening, we're still structurally multiples above pre-GFC levels. Silver in 2011 peaked near $49 when QE2s was in full force, and real rates were deeply negative. The monetary base had expanded dramatically, but nowhere near today's levels. So the bullish argument says, if the monetary base has increased sixfold and silver hasn't made a new inflation-adjusted high, it's lagging. Eventually it reprices. What that means is silver could be undervalued relative to long-term currency debasement. What it doesn't mean is that monetary base automatically translates one-to-one into silver price. Velocity matters. Demand matters. Industrial cycles matter. We've had massive balance sheet growth without proportional CPI or commodity response in certain periods. Third data point, the size of the silver market relative to global assets. The annual silver market is tiny compared to global equities, bonds, and real estate. Annual mine supply is roughly 800 to 900 million ounces. At $33 silver, that's under $30 billion in new supply per year. Compare that to the U.S. equity market alone at over $40 trillion. A relatively small shift in capital allocation, say 0.5% of institutional portfolios, could theoretically overwhelm available supply. That's the argument. The silver market is small. It doesn't take much capital rotation to move it aggressively. What that means is silver has convex upside. It can move faster than gold in speculative phases. What it doesn't mean is institutions are about to reallocate meaningfully. Most pensions and endowments still allocate near zero to silver. Gold gets the attention. Silver is often treated as a high beta industrial metal. So now let's build the bull case. First, structural supply deficit. We've seen multiple years where silver demand, especially industrial demand from solar and electronics, exceeds mine supply. If green energy expansion continues, that tightness persists. Second, real yields turning sustainably negative. If the the 10-year yield drops below inflation and stays there, historically that's fuel for precious metals. Third, a gold breakout above $2,500 with momentum. If gold establishes a new regime above prior highs, silver typically outperforms in the later phase. Fourth, a genuine loss of confidence in fiat currencies. Not just inflation, but a credibility event. That's where you see extreme ratio compression. Could all of that align? Yes. But to reach something like $3,147, we're not talking about a cyclical bull market. We're talking about systemic monetary restructuring. I assign the full extreme bull scenario, meaning silver north of $1,000 within a decade, about a 20% probability, silver to $3,147 specifically. That's embedded in that tail risk. Now the bear case. First, industrial demand sensitivity. Silver is half monetary metal, half industrial. If we enter a recession that's slowing manufacturing, demand drops. Second, sustained positive real yields. If the Federal Reserve keeps policy tight and inflation moderates, real yields could remain supportive of the dollar and suppress metals. Third, substitution and thrifting in solar panels. Manufacturers reduce silver load per panel over time. That caps runaway demand. Fourth, capital flows preference. In crises, institutions still default to treasuries and dollars first, gold second. Silver often lags in early stress. If we avoid monetary disorder and instead get disinflation with moderate growth, silver could trade sideways between $25 and $40 for years. I give the prolonged stagnation or failed breakout scenario around a 30% probability. Now, here's my middle case, and this is where I'm positioned mentally. Gold grinds higher over the next 5 years, potentially into the $3,000 to $4,000 range, as debt burdens force gradual financial repression. The gold to silver ratio compresses modestly toward 40. That would imply silver somewhere between $75 and $100. Not 3 down to even 47. Not collapse. A strong but historically consistent bull cycle. I assign that middle outcome about a 45% probability. Let's zoom out historically. In 1980, silver hit nearly $50 during the Hunt brothers squeeze. Inflation was double digits. The Fed funds rate went above 15%. It was a very specific conference. High inflation, speculative mania, and market cornering. In 2011, silver again approached $49 during QE and sovereign debt fears, but inflation was structurally out of control. The rally reversed sharply once liquidity expectations shifted. Similarities today: massive debt, large central bank balance sheets, geopolitical fragmentation, differences. Inflation is volatile but not entrenched at double digits. The Fed still has policy credibility relative to the late 1970s, and there is no obvious concentrated attempt to corner the silver market. So could we see a powerful rally? Absolutely. Is this structurally identical to 1980? No. Cross-market context matters. Gold right now is strong but not parabolic. It's consolidating above prior cycle highs. That's constructive. The dollar index, the DXY, is not collapsing. It's range-bound. A sustained break below 100 would be more supportive for metals. The U.S. 10-year yield remains the critical variable. If it drops below 3%, while inflation expectations stay near 2.5% to 3%, real yields compress. That's bullish. Right now, we're in transition, not crisis. Positioning tells us more. CFTC commitment of traders data shows managed money increasing net long exposure in silver, but not at 2011 extremes. Commercial hedgers have added some shorts, but again, not at panic levels. Banks are not aggressively trapped. Institutions are not massively overweight. We're early to mid-cycle in positioning terms, not euphoric. So here's my action plan. If gold breaks above $2,500 with the gold to silver ratio falling below 60, I add to silver on pullbacks. That's confirmation of regime shift. If silver spikes above $50 in a short time frame without real yield confirmation, I trim 20-30% of my position into strength. If the 10-year yield rises above 5% and holds while silver loses $28 support, I reduce exposure and reassess. Currently, I allocate about 15% of my portfolio to precious metals. Of that, roughly 60% gold, 40% silver. So silver is about 6% of total portfolio value. My stop loss framework for trading positions, not physical holdings, sits near $27. My first major take profit zone would be between $55 and $65. Reassessing from there. This is not advice, just my framework. What I'm not doing is panic buying because someone projected a 4-digit number. I'm not consuming fear-based content that assumes imminent currency collapse. And I'm not assuming that because debt is high, the system ends tomorrow. Markets move in probabilities, not certainties. This week, here's what I'm watching. First, the 10-year yield. Bullish trigger. Decisive break below 3.5% with stable inflation expectations. Bearish trigger. Spike above 4.75%. Second, gold relative to $2,500. Bullish trigger. Weekly close above that level with strong volume. Bearish trigger. Rejection and move back under $2,200. Third, the gold to silver ratio. Bullish trigger. Sustained move under 60. Bearish trigger. Expansion back toward 75. Those three together tell us more than any headline target. So let me summarize. The math for $3,147 silver is conditional. It requires extreme gold prices and historic ratio compression. Silver does have convex upside due to small market size and structural deficits. The bear case is grounded in real yields, industrial cyclicality, and capital flow inertia. My base case is a strong but contained bull cycle, not monetary apocalypse. If you want grounded analysis without the clickbait, subscribe to Financial Briefing. We'll track the data together, adjust when probabilities change, and stay disciplined. I'm not here to sell you anything. I'm here to measure risk. Until next time, stay sharp. 3,147, Silver Explained, Gold Ratio Math, Monetary Reset, and Reality Check.